Did you know that seller concessions could save you thousands of dollars in upfront costs when buying a home? If you're planning to use a conventional loan, understanding seller concession limits is the key to maximizing your savings in 2025. Seller concessions can significantly reduce your out-of-pocket expenses, but there are rules and limits that you need to know so that you can make the most of them. Seller concessions are contributions from sellers, builders, or agents towards your closing costs. And that's why concessions are also known as interested party contributions, or IPCs. Someone with a financial interest in the transaction helps the buyer close a deal. Mortgage rule makers put limits on how much an interested party can contribute to ensure you're getting a fair deal and the home price isn't manipulated. Importantly, lenders cannot provide these types of concessions, though they can offer credits towards loan fees that don't count towards IPC limits. Here's how the limits work for conventional loans. You can get 3% of the sales price for down payments between 3% and 9.99%. You can get 6% for down payments between 10% and 24.99%, and 9% for down payments of 25% or more. For comparison, FHA and USDA loans allow up to 6%, and VA loans cover all normal closing costs plus an additional 4%. Seller concessions can cover closing fees, prepaid expenses like taxes and insurance, loan origination points, discount points, or even HOA dues. However, they cannot be used for down payments, reserves, or minimum contribution requirements. And there's no cash back at closing except to refund your earnest money. Here's how to get the most out of seller concessions. 1. Use them to cover closing costs, reducing the cash that you need to bring to the table. 2. Excess concessions can lower your interest rate or even adjust the home sale price. As an example, let's say you're buying a home that's priced at $450,000. You decide to put 3% down, which is $13,500. Then, let's assume an estimated $8,000 for closing costs. Your total cash to close might be around $21,500. With a $9,000 seller credit, you could cover all of your closing costs, and then you could leverage the excess concession, in this case $1,000, to buy down your interest rate or negotiate a better deal. Here are a couple of potential issues to be aware of. All interested third-party contributions must be disclosed. Gifts or perks like moving expenses that could complicate your loan if hidden. Also, if the seller pays for your buyer agent commission, it doesn't count towards those limits. So don't let that cause any confusion. So, how do you get seller concessions? And why would a seller give away thousands of dollars? Well, typically it's because they want to sell the home fast and maybe they haven't received as many offers as what they were hoping for. Each day the seller holds the home, it costs them money. So attracting buyers with concessions can pay off. To increase your chances of getting seller concessions, target homes that maybe have been on the market a little bit longer or in buyer-friendly markets. Also, use property issues found on the inspection as leverage to negotiate concessions for necessary repairs. And be sure to work with a skilled real estate agent to craft offers that appeal to sellers while including concession requests. In today's market, rising costs can make buying a home feel overwhelming. Seller concessions are a powerful tool to help bridge the affordability gap and make homeownership more attainable. For more tips on navigating the home buying process, visit mortgageresearch.com. And don't forget to like, share, and follow for more homeownership insights. Thanks so much for watching, and we'll see you in the next video.